Today, this evening, we answer the question: how do I survive inflation in retirement? I actually have been getting a lot more inflation questions, and with good reason. Inflation is at 30, 50-year highs. When you're trying to figure out how does that impact my retirement, you are trying to understand what changes I need to make. You're trying to understand how much money do I need? Should I change how much I spend? And because I get so many questions about inflation and retirement, I said, let me make a video about it. And I think it's something that I'll try to do monthly because when you're trying to understand inflation, you have to look at it from the perspective of the overall economy. And so basically, whenever the jobs report comes out each month, the Fed gives us a lot of information. They have the different meetings, and we can kind of go through that. But the plan is, I'll go through the briefing that the Fed gives us when they talk about the jobs report, and I'll give you a view from someone who looks at it from a financial planning perspective, where you may look at it and you may see them talk about it on the news, but they're not necessarily giving it to you from the perspective of what do I do now with my retirement? Should I make any changes? Should I stay adjustments? And we'll go through that today, so that way you have that view. And I do think it'll be very beneficial to you. So what I will do is I will actually share my screen so that I can show it to you exactly. Perfect. All right. So I think I shared a good deal. All right, so let's go through this. Now, I took it straight from the horse's mouth. So we're on the US Bureau of Labor Statistics. I find that if you guys know, yeah, the news high level sometimes on what commercials and advertisers want the perspective to be, right? Like that's ultimately what is going to happen when you're looking at this information. So we don't always know if they're giving us the best view. Sometimes some of the information is, it's like it's missing a piece of it, if the best way I can describe it. So I'm going to give you the literal bulletin. We're going to go through it line by line, and we're going to see what information they're telling us, what adjustments I should make, and whether or not I should be concerned when it and whether it's going to ruin my retirement or not. So you can see that this bulletin, this was came out Friday, September 1st. The jobs report comes out on the first Friday of each month. And so I will share it with you, and I'm doing this monthly, and we'll just see how it goes. If you guys like it, give me a thumbs up, let me know. And if you do, I'll keep doing it each month, and then we can make adjustments from there. So you can see that this past month we increased the number of jobs by 187,000 in August. Now, if you're trying to figure out how that looks towards estimates, people were expecting it. The forecast was 170,000. So we beat the forecast. I mean, relatively speaking, we matched it. So that means pretty good high level as far as the way your stocks generally perform when you have that immediate bump where everybody's saying this is what we expected. So that means it's already baked into the cake. You'll hear that a lot when people talk about investments, where it's already baked into the cake. And what that means is, as long as everything happens the way that it's been forecasted, that means that whatever the market already has as far as the values of certain stocks and companies, that value should maintain the same. Now, we're not saying that even if there was a drastic change that you should buy or sell stocks just based purely on that. That would be called speculative trading, which just means you're going off market sentiment. And I can appreciate that when it comes to maybe like 5% of your fund, just kind of the extra where it's your gambling portion, where you go for Bitcoin or crypto, or you want to do some option trading, sure, do that with like 5%. But when people tell me that they're going to bet their entire retirement on whether they can guess something right, that's when you got to be a little concerned. And interesting enough, the unemployment rate actually rose to 3.8%. It's kind of nominal. It was like 3.7 and went up to 3.8. You'll see the last paragraph of their bulletin actually explains a little bit why. Because if you're saying, well, if we hit the estimates and we're still adding jobs and the economy still seems pretty good, why did the go up? Which would be a fair question. And it does give it to us on the end, and we'll go over that. And they say they give you the sectors that unemployment is doing very good. You guys know, as far as my philosophy when it comes to building a portfolio, a nice diversified portfolio, I'm someone who believes that you look at it from the economy down. And so what that means is, what is the overall economic sentiment? What are people feeling? Are we in a recession? Are we in a time of economic growth? And what that means is which sectors perform best in those. And then we investigate the companies, and then we do the fundamental analysis. We look at their overall financials and we see if it's a good investment, if it's a good company. But there is just, for me personally, someone who has a master's and a bachelor's in economics, I find more comfort going from the top down. You'll find people that go from the bottom up, which means that they find the companies, they find great companies. It doesn't really matter what sector they're in, and they just buy them and they invest in them. I think both are fine. It really depends on what makes the most sense for you. But they said the employment trends is good in healthcare, leisure and hospitality, social assistance, and construction. And employment and transportation housing is actually declining. Now, this one, for someone like me, when I'm looking at that, the first thing that I do is I say, okay, what has happened to cause this? And what has been kind of we've been dealing with in our economy for the past 5 years? Well, you would say COVID. All right, so what does COVID have to do with healthcare? Well, healthcare does really good because everybody's investing in these vaccines, and we're staffing hospitals. We're going through things. Something else that you'll notice is we have the baby boomers retiring. Because there's so many people retiring, they have to have the staff to be able to take care of this influx. So whether that is just good old fashioned healthcare, going to your doctor appointment, having surgeries that people have been putting off from COVID, going back and just getting their regular checkups and different things, or whether this is still the company's doing really well, investing in these vaccines and helping people out, whatever that is, we're still seeing good signs in the healthcare industry, leisure and hospitality. Well, we know everybody was stuck in their house for a while, so we know that people are traveling. Also, we know that even though it is the beginning of September, that some parts of America are still in their summer. So they're still taking their vacations with their family. So this is a lagging indicator. So that's not surprising either for me. You also have a lot of summer seasonal jobs where people are hiring people for the summer. And so there are certain things that you're like, okay, that makes sense to me too. People are traveling, they've been locked up, they're ready to get out and do things. What do they normally do? They normally take more vacations. If you got the retirement set up in the way that you would like, you're going to spend more of your time doing things that bring smiles to your faces. So again, no surprise there. Social assistance, we're talking about people right retiring, whether they are going to see like a therapist, or they're having like in-home care, or they're going to different places. And then construction, we're just building things. We're fixing roads. Often construction is something that you see when you're building new houses. And why do we see people building more stuff? And I would say a part of it is buying a home that's already built, like a home that's for sale, is really hard. And it's still, even though the inventory is starting to slowly get back into what is considered reasonable, it's just really hard. You guys have seen that people are bidding the asking price. People are bidding 10, 20, 30% over the asking price, where maybe someone just said, you know what? How about I just build a home? I just find empty land, I just build a home. Or, and a lot of people made that decision because you just can't keep paying in these bidding wars, and where you're overpaying for a house and you have buyer's remorse. So we're saying maybe I will do some construction. Also, if you think back to COVID, we had a lot of logistical problems, which is a very fancy way of saying a lot of the stuff that was supposed to be built wasn't built because all of the countries were closed, the borders were closed, the logistic nightmare. We talked about that with everything from like baby formula to hand sanitizer to toilet paper. You guys remember how, again, this is us getting over that hump as well. And then employment and transportation and warehousing declining. If you had to guess, why do you think it's declining? Right, and I would say it's declining because when we had the first, COVID was ending, huge logistical problem. Everybody and their mama probably opened a trucking company. Why would you do that? Because there was so much stuff. Everybody's willing to pay whatever the price was. And if you were someone that needed a job, they were considered, I forget the exact term, but it was like they were considered is allowed to work during that time. And because they were allowed to work, if you had that type of a business, then you did pretty well. You were able to take care of business. You were able to keep the food on the table, keep transporting and doing these amazing things. Well, when COVID ends and we get back to normal competition, a lot of these companies probably closed. And so you'll see that as well. And the warehousing declines, the same deal. We had a lot of logistical issues. People were holding a bunch of supplies. Now we're emptying the supplies. Everything's back. Well, naturally, that means that they're going to close. So again, nothing surprising there. That's a normal ebb and flow of an economy. So there's nothing crazy there for me. So we'll go ahead and we'll skip down to the household survey data. And so it says the unemployment rate rose by 0.3%, which brings us to the 3.8%. And that is the number of unemployed persons increased by 514,000 people to 6.4 million. And so and it lets you know, it always gives you what 514,000 people sounds like a lot, but is that a lot for, the United States of America? It says both measures are little different from a year earlier when the unemployment rate was 3.7% and the number of unemployed persons was 6 million, right? So it's saying, hey, that's about what you would expect. Nothing has really changed. We had some ebbs, we had some flows. It's nothing really changed. And then it lets you know, it breaks it down by race and by gender. And so it says the unemployment rate for adult men was 3.7%. White men is 3.4%, Asians 3.1%. They rose. Their unemployment rate rose in the month of August. And then the jobless rates for adult women, 3.2%, teenagers, 12.2%, blacks, 5.3%, Hispanics, 4.9%, showed little change over the month. So they were about level, trickle down, but about the exact same as far as the percentages are concerned. Among the unemployed, the numbers of job losers and persons completed temporary jobs increased by 294,000 to 2.9 million in August, offsetting a decrease of 280,000 in July. So again, we're just talking about seasonal work, people getting hired in the summer. Also, when you're thinking, all right, if the unemployment is for white males was increasing in Asian males, it's what sectors would they be overly concentrated in that would explain why that's happening, right? See, the thing about numbers is it's the numbers are the numbers, right? And if you watch it on TV, they can spin anything. They could make it seem like people are being attacked or oppressed. But if you think about the sectors, you'd probably say the technology sector. When you say that number one, you'd probably say technology number one, where you have a bunch of the tech people. Well, what has tech been doing for the past 12 months? They've been steadily laying people off. Look it up. Look at Google. Look at Facebook. Steadily laying people off. So Silicon Valley has been pulling back, just generally speaking. So that it helps explain why certain industries are pulling back, certain industries are moving forward. So that to me isn't very surprising based off of what I've seen in the economy. You in the comments, let me know if you feel differently. But for me, I was like, that isn't surprising. And so we see the number of job losers and persons who complete temporary work. We talked about that. It increased. So it's just getting rid of the people. They hired them in July. Summer's over. They fired them. And then in August, the number of new entrants edged up to 597%. New entrants are unemployed people with no previous work experience. So that's our teenagers, our kids that are somewhere maybe like, I think 14, you can start working where you can work like 3 hours and you have to have a break. 13 or 14, I think it's 14, yeah, 14, 15, at least in Florida, right? It may be different in your state. But in Florida, so new people without a job and no work experience. So that'll be what we consider unskilled labor. Not a sexy term, but the economic term. Just means that they don't have any skill, they haven't worked yet. So that increased. So there's about 600,000 people that entered the workforce that had not been there the previous month. And so that, again, people getting their first job in the summer, not too surprised about that. And then it says both the numbers of persons unemployed less than 5 weeks at 2.2 million, and the number of long-term unemployed, those who are looking for jobs for more than 27 weeks, and that's at 1.3 million. Those both increased in August. Now, if you are looking for how does that impact inflation, how does that impact my retirement? Well, the Fed has made it clear that their goal is to lower inflation. And the only way to lower inflation is its relationship with the job market. Inflation increases as a lot of people have jobs. And because they have jobs, the only way I can get you to come to my business from your current job is to pay you more. So I'm going to pay you 10, 15, 20% more to get you to come from your job to my business. Well, what that ultimately means is twofold. One is it means there's more money in the economy, so more people are spending their money, which causes inflation. But two, because I increase my cost, because now I've increased my labor cost by 20%, I have to raise my prices. If I don't raise my price of business. And so it ends up hitting us twice, where the cost increase because the cost of labor is increased. And because the cost of labor increase, you have more money. And so we keep spending all the money. We buy everything off the shelf. And as a result, inflation keeps going up, right? I have to keep paying people more and more money to come to my business because I have so much demand, but then I have to increase my prices so much. And as a result, the Fed said, you know what? Let me see if I can fix this. How about I raise the interest rates in hopes that it will cause the people to have less money in the market? Now you'll say, Dre, well, how's the rates less money in the market? That's an excellent question. So I'll give you a couple of examples. The first one is, have you been trying to buy a house lately? What has happened? The interest rates on your houses have gone up. Well, what does that ultimately mean? Bottom line, that means that you can't buy as much house as you were able to buy. So now you're buying much less house and you have to pay the exact same price. So as a result, that means that if each of us, so right, if I was able to buy $1 million house and now I can only buy a $700,000 house, and then the person who could buy a 700,000 house, now they can only buy a $500,000 house, and then it keeps able to buy a house at about two, can no longer buy a house. So they have been just pushed out of the economy. So that pulls some of the money out. Also, businesses, you and I both know, businesses take loans out to run, to grow. And as a result of higher costs in their loans, they can't take the loans as much because the monthly payment would be too much for their business to actually make it enough to pay it back. So now businesses are slowing their growth down because they don't have the ability to take the loans out. So you can see how the Fed increasing the rates is going to increase unemployment because as businesses demand lowers, then people have less money to spend. And as people have less money to spend, they have less money and they start buying less stuff. And as my shelves get full in my business, I start laying people off. And as I lay people off, eventually it will slowly lower enough to where I have to lower my prices. The price that I did have because I was fighting to pay everybody so much. Well, now I'm laying people off. Nobody's buying my stuff. I lower my prices. And that's how you get rid of inflation. So that is why these numbers going up is actually good from a inflation my retirement plan perspective. And so the Fed looking at that is probably like, okay, this is getting a little better. I feel a little bit better about this. And I will show you what the I'll actually show you exactly what that looks like as far as the inflation going down, because it has gone down considerably year over year. So what they're doing is working. So a lot of people are losing their jobs, a lot of interest rates going up. So now people aren't selling their house. Imagine if you had a house at a 2-3% interest rate. And if you were to refinance it, that you would have to get like a 5 to 7% interest rate. A lot of people are saying, you know what, Dre, I can't. I'm not going to refinance my house. I'm not going to lose this amazing interest rate and end up having to pay that extra. So you have that going on as well. All right. So the number of people in part-time work, we're going to go past that. The number of persons not in the labor force who currently want a job is 5.4 million. So this one is actually one that we don't actually talk about a lot. And what is it's called the U3 versus the U6. The U3 is what we show, I would say, like the majority of the time. The U3 is the unemployment rate with people who qualify to count as unemployed, which is a very fancy way of saying they have to be actively looking for a job. Actively looking for a job, that's the U3. That's the unemployment rate that you see. So that's the 3.8%. But if you count the people who just have given up, right? They're just frustrated. They've applied for 300 jobs. They've gone on dozens of interviews. And for whatever reason, they're not getting the opportunity. Those people are the ones that leave the workforce and they're not counting 3.8. Well, that number is 7.1% if you count what's called the U6. And so there's really 7% of people that are unemployed that want a job and just haven't found it, but they're not actively looking because they've been looking for a long time and they feel frustrated by just getting rejected all the time. So we end up not counting them when we say 3.8%. About 7.1% is what is the unemployment rate. Like again, a sign that we're getting inflation under control. Everything is kind of going according to plan. The only question is, when will the Fed recognize when to stop increasing the rates? And you'll hear them say all the time, they'll be like, we're looking for a soft landing, a soft landing, a soft landing. And all that means is they want to be able to stop this right at the perfect spot. So let's say unemployment gets to maybe like 4% and then maybe 4.5%, where they don't want it to get to 6, 7, 8, 10%. That's called a soft landing, where they take their foot off the lever right around that 4.5%. That will put inflation in a really good spot, and then everybody should feel a lot better overall. That's what we're trying to do. So then we'll keep going on that. Right. So it talks about some of the jobs, and we'll see how it shakes out. And so on average, we have added 271,000 jobs over the past 12 months. So the 187,000 is significantly lower than that. Again, Fed says that's a good sign. You and your retirement plan dealing with inflation, you would say that's a good sign as well. And then when you talk about the healthcare industry, it says they added 1,000 jobs. And then that follows similar trends for them, and that their job growth is in ambulatory healthcare services, right? Nursing, residential care facilities. This is the stuff that you'd say, okay, if I follow the baby boomers and the things that they'll need and the services that they may have, then I can say, all right, this is going to be increasing as we go on. Employment in the leisure and hospitality, we talked about that. That was up 40,000. It says the industry gained an average of 61,000 jobs per month over the last. So that's below the average in that, but the employment below pre-pandemic February 2020. That's interesting, right? 290,000 jobs, what we had in 2020, right before the pandemic, and everybody got laid off because you couldn't go anywhere. And so right now it says that we're still below that. So that would hospitality and leisure is still a great industry, a great sector to invest in because they're just not where they're not even back at 220 or 2020 numbers yet. So that's probably pretty good. You can see here employment and social assistance increased by 26,000. That's in line with where they've been on average, and that the individual and family services, right? So again, family is trying to get back. There's a lot of we talk about the physical issues from COVID, but we don't talk about the mental as much. But there's a lot of people. And then we'll end with the positive on construction. So you can see that that was at 22,000. That was again about in line, slightly above it, 17,000, and that the industry continues to trend. And it says it's trending due to specialty trade contractors and heavy and civil engineering construction. So those are what's leading that sector. Most things you'll find that, hey, like if you have a specialty, right? If my foot is broken, I'm not going to just Google a doctor. I'm going to Google foot doctor. If I need a heart surgery, I'm not going to Google heart surgeon. And so if you have a specialty trade, so you're building a hotel, then you would want someone experienced building hotels. If you're building, roads and things like that, you want someone who has specialty in building these particular obstacles or these particular projects. And so that makes sense as well for me. Now, again, transportation and housing, we would expect both of them to go down because they were kind of inflated because of COVID. And then they say employment in the truck transportation, it fell sharply, 37,000, and largely reflected business closures. People that open businesses during COVID, deal with the trucking, probably made a ton of money, and they just closed up. The margins probably got small, they got tight. It just wasn't working for them anymore, so they probably closed up shop. Some of them, they just weren't able to compete. The gas prices starting to trickle back up, and they didn't really understand how to run a trucking business. They jumped in during a time, they took advantage of it. It'd be no different than someone who opened a mask making business. That was a fantastic business during COVID. Now, probably not so much, right? You're probably not able to keep your doors open. Made the millions of dollars during COVID, but you probably want to go ahead and kind of leave that be. So couriers and messengers lost about 9,000 jobs, while transportation added 3,000. It says employment in transportation warehousing has shown little change over the past 12 months. So to me, that means getting back into normal. There was the excessive growth and where we're filling in a need. And as that need is gone, it's kind of changed. And then you can see, and we're not really going to go through all this because again, you're just trying to make sure how does it impact my overall retirement plan. And when it comes to inflation, we're going to talk about how that impacts each of your investments and what type of investments you should have to help you hedge against inflation. So you can see the overall, I'll go ahead and I'll skip to the bottom, and because I told you, hey, this is going to be kind of important for you. And you can see here down at the bottom, look at that. When you're trying to figure out, oh, unemployment rate went up. Why did it go up, Dre? Well, look at here. It said the change in total non-farm payroll employment in June was revised 80,000 jobs. So now, without it being nefarious and all that extra stuff, there's a lot of numbers. Then they talked to a lot of people, a lot of industry saying we filled the person, and then maybe the background check didn't go through. Maybe they ended up building a new department and it flopped, so they fired everybody. Or maybe you accepted 3 jobs, and so everybody said that you accepted it, and then you took the one that maybe paid you the highest. Whatever the reason was, 80,000 jobs that were said to be in June were removed this past month. So again, that would also lead to the possible increase in the unemployment rate. And then look, they revised July as well. It was revised down by 30,000. So another revision down. What does that mean? That means it is a combined 110,000 jobs that were like lost as far as what was already baked into the cake. Those are 110,000 jobs that were lost. So if you think of it from that perspective, where you had 190,000 jobs added in August, but then you technically lost 110,000 jobs from the revisions. So then you really only added like 70,000 jobs, like 70, 80,000 jobs. What do you think that would do to the unemployment rate if you just said we added 80,000 jobs? You'd say, yeah, probably increase it. Again, now this is probably pretty good when it comes to to you and your overall retirement plan. But let's go ahead and inflation impacts my retirement and what I should do to hedge against it. And so I will stop sharing my screen for a second and let's just have the conversation about how inflation impacts you. So if you have your money invested, right? So we're going to talk through each of the investments and then you can decide whether that makes sense for you to stay in that or not. So when it comes to your normal investments, the way that you have is, let's say inflation, and I think I have it. So inflation was in 2021, inflation was 7%. And so what that means is for you to actually technically make a dollar off of the money you have invested, you have to at a minimum beat 7% in your investments. Now, if you think of it that way, if that means that just for me to make 1%, I have to make 8% because 7% of the money is already inflation. So you were able to spend a certain amount of money last year and it costs you 7% more to buy the same products to maintain the exact same lifestyle. This is why inflation is seen as a retirement killer because most of us, like if you're changing your investments because you're retired, then realistically, you're not invested in things that are generating a 7% return because you went from capital accumulation to capital preservation. A very fancy way of just saying that you don't have the bandwidth to be able to risk your money on go big or go home. And as a result, you're probably somewhere around that 4 to maybe 5% is what the returns that you're probably getting, which means that you're technically losing 2% every year because inflation was at 7% for 2021. That's why inflation is so dangerous for us when we retire. Now, for the people who have enough time for retirement, well, they can change their investments. They can still be aggressive. But if you were just investing in a safe option, like you're like, hey, look, I'm going to spend 5%. That's my withdrawal plan. I have an investment that's going to generate 5%. I'm going to be great. But then you have inflation where you're technically losing that 2%. That's a really rough spot to be in. And it's very hard to make that back up. So let's talk about fixed investments. So this like bonds, CD, only consider fixed investments. The reason that now that it has a negative impact on that. So there's generally an inverse relationship when inflation is high, and the reason is pretty straightforward. So if you think of your bonds and your money markets and all your short stuff, if you think back to 2019, they're probably like 0%, right? Like, I mean, crazy number, like less than 1%, because the inflation was zero and the Fed's interest rate was so low. So everything was low, right? You could buy a house and for 3%. Well, what does that do for your returns? Well, you're only able to get like 1% on it. Well, because you have a bond at 1%, when interest rates go up, what has been happening to bond prices? Right? They've been going up because there's a higher rate in the market. So now you've seen the Apple bonds where it was, or the Apple high yield, I think it was a high yield savings account, but it's basically a bond. And that was at like 4 or 5%. As a result, there's so much more money to be made by investing in a bond today that your bond from 3 years ago is very hard for you to sell because it's only paying like 1%, and I could buy something at 5% today. So it ends up having a very negative impact on long-term bonds. If you had a 10-year bond that was paying like 2%, and then the bonds today are paying 4 or 5%, well, that's going to be hard for you to move off of that. And so as liquidity dries up, as people aren't interested in that, it actually lowers the value. Like you would have to almost beg them to buy that bond because of how beneficial the bond price is now. Where if you were maybe it was worth $1,000, you may have to sell it for 800 just for someone to be willing to buy it, which is going to have a huge impact on your retirement. So you can see how that has a negative impact. When you talk about your stocks, how does inflation affect your stocks? It really depends on where you're invested. Like it really does. There are some sectors that do pretty well during inflationary times, like banks. They have the ability to pass the cost on of higher interest rates, high inflation to their customer effortlessly. All of us know that our rate and our mortgage and our cars and everything is tied to the interest rates, and so we don't really ask any questions about that, right? But if you had a business where it's very hard to pass the cost down, then you may be eating that as a business to where maybe your costs increase by 10%, but you can only raise your prices by 5%. Well, that negatively impacts certain businesses. So what that means is you have the possibility of some of the businesses that you're investing in, as the rates go higher and they can't grow anymore, they don't have the ability to get that extra money. And so growth stocks generally perform poorer during times of inflation, while value stocks, which is generally a stock that's trading below its intrinsic value, which is a very fancy way of saying that if you calculate what you think the company is worth and it's actually trading below that, those companies generally do well. The extra loans and the extra money to fund their growth. So if you're dealing with high inflation, normally when you're in stocks, you normally would lean towards value investing and you wouldn't focus as much on growth because growth companies are taking on debt. Well, we just talked about that. If you're taking on debt, that means that you're paying a certain amount of money that you don't really have the access to anymore. And if you do access it, the rate is so high that you have to make that much more money just to cover the cost. So your cost of goods goes up. And so normally it mixes, but as far as generally speaking, value stocks perform better during times of high inflation. Growth stocks perform worse during times of high inflation. Now, when we talk about real estate actually is one of those things where the cost is passed down, is built in pretty nicely. So generally, if you're investing in real estate, that does perform well during times of inflation. As the price goes up or the price goes down, most of us accept that when it comes to real estate. We don't really question that one either. So real estate is normally a decent place to be able to have your investments during times of inflation, where you have the ability to hedge against that. So I would even think of real estate because if you look at the growth of like a REIT, so a real estate investment trust like a REIT, if you're investing in that, that those are just basically you invest in companies that buy the real estate and do all the management for you. So it's like you're investing in and as a silent partner in an investment company that's going out and buying the investments and running it. Those are nice because if you ever wanted to buy a mall or a huge apartment complex, well, you may not have millions of dollars to do that, but you like the idea of having thousands of people as tenants. You like the idea of commercial businesses and their rent per month. Well, you invest in a REIT, you have access to those type of portfolios. So they're really nice. And then most of the time, people will go off of bonds and they'll switch to the real estate because normally real estate is not very correlated with the stock market. So you still have that protection of if we go into recession and like the stock prices go down, there's not as strong of a correlation with real estate to where you're still able to have that good diversification in your portfolio. So that one normally goes pretty well. Now, when it comes also to so not only real estate, but really if you have like oil and different commodities normally perform pretty well during inflation as well. Again, these are certain industries where it's very effortless to pass on the cost. You're right. You and I, we go to the gas station, you go once a month, and the price could go up by 25 cents, 50 cents, a dollar, and none of us really ask any questions about that. We need gas, so we sort of pay for it. So normally commodities is a pretty good place to be in as well. High level, when you're dealing with inflation in your investments, as much as you generally want to be in capital preservation mode with the bonds because they're so negatively impacted, because you're technically end up losing money because of the inflation. It's normally in people's best interest to diversify into real estate and into some value investments because it at least to hold you over during the time of inflation. Now, if you're someone who's like, Dre, that's too much risk for me, I'm very uncomfortable with that, then you can invest in what is called treasury inflation protected securities, which is like TIPS. And those perform very well because inflation is built into them. So if inflation goes up by 6%, the TIP cover that for you. So you'll be able to maintain your overall returns. Now, they do cost a little bit more, but it does provide you the protection that you'd normally be looking for. So I don't think it's right. It's always a give and a take. If you stay in the bonds, well, yeah, they're cheaper because they're not as valuable. But so it really depends on you and just how you overall feel about that. And I will show you where we're at, and then we will be done. I'll show you right now where we're at on the current inflation and how we're tracking and what that looks like for you going forward in your investment. So I think the current inflation, here we go. All right. So yes. All right. Let me zoom in a little bit. Currently, the U.S. inflation, you can see this is where we've been at after the recession. 1.5, 0.8, 0.7. This is like nothing. 2%, 1.4, like nothing. 2021. After COVID, we saw boom, 7%, 6.5%. Now it's down to 3.2%. So we talked about that soft landing that the Fed's trying, whether or not they'll ease off. So as far as I mentioned in the beginning, there's a certain amount that's baked into the investments, into the stock market, where if they do this, nothing's really going to change in your portfolio. Right now, the stock market has baked into it about October, to where the Fed, if they raise the interest rates in September, They raise it in October, most people are going to be like, that's what we expected. If they raise it again in November or December, you'll probably see a very negative reaction in the stock market because it's not baked into it. Most people looking at these numbers are saying, look, inflation is about at the 3% that you were looking for. We're about right where we need to be. Maybe we can, lower it, stop raising the rates, hold it, let people start getting to work, let things stabilize. Let's see where we're at. If you keep increasing the rates, then you may drop us into a recession or even worse, into a depression. Most people believe that it's going to stop around October. That's where most people are at. And if we have the soft landing where we're not in a recession, you're going to see a pretty nice bump in the stock market. Now, again, that's just sentiment, but people will just feel good. They're going to be like, all right, you didn't raise rates. That's great. I feel amazing. And whatever the unemployment rate is, whatever we're at, that's probably going to be the hold pattern. Like, that's the idea, is we got enough people unemployed. We got enough people unable to spend money. Everything's kind of going back to normal. Let's go ahead and we'll ease off and we'll just watch and wait and see. And then, of course, if the Fed gets it wrong, then we'll go back to 2000. The Fed lowers rates, growth, free money's out there for everybody. It creates like another bubble. So everybody's able to start investing and buying things, and it just goes like that. That is the economic flow. That's why I follow the economics of it more, because the pattern is so recognizable. So with that is it. If you have found value in this, I just ask you to subscribe, like it, share it. If you have any questions, feel free to email me, dre@wisdom.com. Ask your questions in the comment. If there is a particular topic that you would like me to do on the next live stream, or you just find value in this one where I go over the economics of our retirement plans each month, I could do that for you too as well. I do appreciate you for listening. And I think we actually passed 500 subscribers, so I appreciate you for that too. It means